37,121 Canadians filed for insolvency in the first quarter of 2026. That's the worst quarterly print since 2009. So you may have heard of that year. Obviously, it was the global financial crisis. It's up 18.8% year on year and up roughly 26% the 3 months between December and March alone. And here's the part that breaks the standard narrative. These are not subprime borrowers. These are not the deadbeat in a trailer caricature type of financial media loves to roll out when arrears tick higher. These are prime, employed homeowners. People with real equity, real jobs, and what used to be a real mortgage. Scott Torrio, one of the leading insolvency trustees, just said, and I'm quoting him directly, they are now seeing an increasing number of filers with well-paying jobs. And the part nobody on financial TV wants to spell out is that Canada is just the leading indicator. Because if you follow this channel, you know how the cycle works. Pain shows up first in the country with the most exposed mortgage structures. Then it rolls through every other Western economy, leveraged into the same post-pandemic debt bubble. We talked about the Australian budget a couple of weeks ago. Well, Australia structurally is sitting in a far worse position than Canada is right now. That's not an opinion, that's just a mathematical fact. Today, I'll walk you through exactly what just broke in Canada, why Australia is the next domino, and why this isn't 2008, but possibly more dangerous for completely different reasons. And if you stay till the end of the video, we'll also talk about the Contagion sequence rolling through New Zealand and the UK, and where this whole mess sits inside the 18-year cycle. So, hit the like button, subscribe to the channel, and if you want the full framework on the 18-year cycle, the free 3-part mini course is linked in the top of the video description. All right, guys, let's get straight into the data. Starting with Canada, 1.15 million Canadian households are renewing their mortgages in 2026 alone. That's roughly 60% of the entire outstanding book hitting the wall in a single calendar year. Most of these households originated their loans in 2021 or 2022 at rates below 2%. They are now rolling into a rate environment 3 to 4 times higher. Now, you might remember this from 2022 when the fear of a recession was front and center. But at that time, we weren't rolling more and more mortgages into fresh new highs on interest rates. There was still time, and I believe that is now come to fruition. We're getting much closer to that time. The average monthly payment increase confirmed by Equifax Canada is roughly $375 per month, so $375 a month. That's per household every month, indefinitely, on top of grocery bills that ripped 28% higher between 2020 and 2025. And the delinquency data is already doing exactly what you'd expect. National mortgage delinquency balances are up 32% year on year. Ontario up 52%, Brampton up 64%, Toronto up 58%, and Hamilton up 61%. The average insolvent homeowner is now carrying $82,400 in non-mortgage debt. That figure is up 19% in just 2 years. So the translation is the credit card was the life support keeping the household solvent, and the life support has, seems like, now just failed. The Bank of Canada is sitting at 2.25% on its 4th consecutive hold. They can't cut further without reigniting the inflation the Iran war is pumping through every supply chain on the planet. And they can't hike without snapping every renewal cohort that has not already rolled over. This is policy paralysis in real time. And OSFI, the Canadian banking regulator, has now officially named real estate secured lending as the primary threat to the entire financial system. I can't believe they didn't figure that out earlier. They are warning of what they call a double hit scenario. Construction layoffs as condo projects complete, with no new starts hitting the exact same households facing renewal at higher rates. OSFI's own words, this virtually guarantees distressed sales. Tell me that doesn't sound like a regulator preparing the room for impact, but it doesn't always come that quickly. It gets worse in Australia because Australia is sitting in a structurally weaker position on almost every metric that matters. You wouldn't think it being here, but the top end is getting hit very hard at the moment. So let's start with the household debt to income. Australia is running at roughly 210%. That's 210% household debt to disposable income. Canada is at 173%. The United States, at the peak of the 2007 subprime bubble, topped at 98%. Australia is carrying double the household leverage the United States had at the very top of the cycle that produced the global financial crisis. Sydney's median dwelling values are trending towards 2 million by the end of the year. The total value of Australian residential property, get this, it hit 12.6 trillion at the end of April. Any guesses what the GDP is in Australia? It's about $2 trillion. Most of the money is tied up in land. And Roy Morgan's latest data has 1.44 million mortgage holders, which is about 26.8% of the entire mortgage book, already classified at risk of mortgage stress. Their forward projections, if the RBA pushes the cash rate to 4.6%, takes that to 1.66 million people at 31%. The National Debt Helpline took nearly 14,000 calls in April alone, up 21% year on year. But the killer structural difference is right here. Canada's pain arrives in discrete renewal waves because of the 5-year fixed structure. You can at least see the calendar. In Australia, less than 5% of mortgages are fixed rate, which means the RBA hikes, the pain transmits to almost every borrower immediately. There is no cliff in Australia, there is just continuous bleeding. And the RBA has already hiked 3 times in 2026. That was in February, March, and again in May. Not a bad place to be if you've got a lot of cash. Cash rate is now back to 4.35%, matching the 2011 cycle peak. Core inflation just ticked up to 3.4%, a 22-month high driven in large part by oil prices the Middle East conflict is keeping elevated. Futures markets are pricing the cash rate as high as 4.75% by year end. That's 1 to 2 more hikes baked into the curve, backed by us, baked into the curve. And meanwhile, unemployment in Australia just jumped to 4.5%, the highest since November 2021, and worse than the RBA's own forecast. Oh, of course, it's always going to be worse than this. So you've got rising rates hitting variable rate borrowers immediately, while the labour market is starting to crack. Roy Morgan's CEO, Michelle Levine, put it best. The biggest risk to mortgage holders is not just rising rates, it's unemployment. Now here is the part where most channels start drawing the 2008 comparison. And honestly, I'd be careful with that one, because what's happening now is structurally different from 2008, and in some ways the difference is what makes it more dangerous, not less. 2008 was a credit quality crisis. Predatory subprime lending, no-doc, liar loans, fraudulent originations packaged into opaque mortgage-backed securities and distributed to balance sheets all over the world that had no idea what they're actually owning. Basically, huge fraud. When it cracked, you could point at a villain. Bad borrowers, bad originators, bad rating agencies. We saw the movie. There was a scapegoat. 2026, it was a payment shock crisis on prime, fully documented, employed borrowers with real equity. These households did everything the system told them to do. They saved a deposit. They got pre-approval. They signed the loan at a rate the bank confirmed they could service. And now the system itself, through the rate regime, is breaking those exact households. There is no evil banker guy to blame. That's the part that makes the political fallout different. And the risk isn't hidden in opaque CDOs sold to Norwegian pension funds this time. The risk is sitting visibly on bank balance sheets in plain sight. Australian Big Four banks hold mortgages at roughly 60% of their total credit book. Global peer banks sit at 40 to 50%. That is concentrated exposure that cannot be hidden, cannot be offloaded, and cannot be repackaged. I'm sure they'll find a way, but at this point, it doesn't look like they can do it. Morgan Stanley analyst Richard Wiles said this week, and I'm quoting him directly as I often do, aside from COVID, we cannot recall a time in the past 25 years when the operating conditions for banks have shifted so quickly. That is a Wall Street bank telling its institutional clients to look at Australian bank exposure with fresh eyes. And the regulators are not standing still either. Look at what the institutional class is actually doing in response. In Canada, OSFI is publicly flagging real estate lending as the #1 systemic risk in the country. In Australia, APRA dropped a 6 times debt to income cap on the entire banking system effective February 1st. Good date that is. Banks are now operating to a quota. That means borrowers near the threshold are being declined not because of personal creditworthiness, but because the bank ran out of high DTI allocation for the quarter. Morgan Stanley is now forecasting a 5 to 10% national price correction in Australia, which would be the largest decline in 4 decades. Westpac has Sydney down 3% and Melbourne down 4% for 2026. And just yesterday, on May 26th, the Federal Court of Australia handed down its $26 million civil penalty against Westpac for failing to respond to over 200 hardship requests during a 6-year period. $26 million? That the banks are making that every day, right, as a profit. Anyway, moving on. Justice Timothy McAvoy called the conduct grossly negligent. He rejects Westpac's proposed $10 million settlement as derisory and wholly inappropriate. ANZ already copped a $40 million penalty late last year. These penalties are freaking useless. NAB told 15.5 million. Oh, they took that as a penalty, 15.5 million. That is the regulator preparing the system for what's coming. I mean, are they really preparing? 3 of the big 4 banks, 3 penalties, all for failing customers in financial hardship. And all this late cycle stress fits perfectly into the 18-year cycle framework. You knew we would get there in the end. We talk about it a lot on this channel. Some of you are already subscribed to the free 3-part mini course. Part 1 is the cycle itself and the 200 years of data behind it. Part 2 is exactly where we sit in the cycle right now. And then part 3 is how we're positioning for what comes next. It's completely free. If you haven't already, go get it. The link's in the top of the video description. So now let's bring all this back together. This phase we're in right now, the final 2 years of the up phase, is what Phil Anderson and Fred Harrison call the winner's curse phase. That's where speculation goes vertical. We're definitely seeing it when it comes to AI now. It's getting further and further. It's also where credit explodes and where the last buyers into the boom take on peak price, peak leverage, and peak payment simultaneously. These are the households that bought a Sydney house at 10 times income or Toronto condo at the absolute peak in late 2021 on a sub 2% mortgage that is now resetting to north of 5%. The old maths does not survive the new rate environment, and the signal sequence in the winner's curse phase is always identical. Affordability breaks first, transaction volume weakens second, delinquencies rise third, lending standards basically tighten as the fourth. Only then do forced sales begin. So we still have more time, but it's coming. Ontario delinquency balances are up 52%, Brampton up 64%, OSFI flagging distressed sales. That's stage 1 through 4 simultaneously in real time. Australia is one stage behind that, with APRA already tightening lending into a market where 30% of borrowers are flagged as at risk. New Zealand is right behind Australia, with the RBNZ splitting 3-3 on May 27th, and the governor using a casting vote to hold for the first time in committee history. All 6 members agreed that hikes will be needed this year. Kiwi Bank called it much more hawkish than expected, and the UK has 1.8 million fixed rate deals expiring in 2026 alone, with the Bank of England now facing renewed hike risk as inflation threatens to come back in the second half. 5 Anglosphere economies, 5 different mortgage structures, 1 identical pressure point. Synchronized stress from a common cause. Elevated global rates the central banks cannot cut because the Iran war is keeping oil prices sticky. That is the configuration the framework has been pointing at for this exact window. Now we know tops are a process. They're not a single event. This can take many, many months to fully play out. We're not calling for a crash tomorrow. We never have done. We never will. We're calling the sequence, watching this topping process. And the sequence in Canada is no longer a forecast. It's happening right now, just like the top of the market in Australia is coming down. So here's what I want you to do. Stress test your own mortgage at 2% above the current rate. If that scenario breaks the household budget, you're already sitting inside the at-risk cohort the regulators are now openly warning about. Don't trust the soft landing narrative. The same narrative was being sold in Canada 6 months ago when arrears were still being called contained. They are no longer contained. And the leading indicators to watch from here are Canadian Q2 insolvency data due in late July, the RBNZ July OCR decision, and the next Roy Morgan stress release out in Australia in mid-June. By the time mainstream media calls this a crisis, the structural moves have already happened and we're probably close to the catalyst. Now, I want to hear from you guys. After everything we just walked through, where does this resolve next? Does Australia crack first as the variable rate transmission keeps bleeding into a labour market already softening at 4.5% unemployment? Does New Zealand go first? I think they've probably already gone a little bit here. Does the UK lead the pack with 1.8 million fixed rate deals and a Bank of England that's about to be forced back into hiking mode? Drop your call in the comments section. I'll be reading every single one of them and replying to as many as I can. Next, hit the like button, subscribe to the channel, and grab your free 18-year cycle mini course in the top of the video description. And don't forget, TIA Pro is on sale this week. We'll leave a link in the video description for that too. That'll show you how I'm navigating this cycle through my crypto, stocks, and real estate portfolio. Until then, take care and peace out.